If you don't mind, I would like to kind of step up the ladder of abstraction and maybe just start with what the interest rate swaps are. Okay.
Yeah.
So in the traditional markets, have you ever taken a loan, like maybe a mortgage? Mortgage is probably a good example. So if you take a mortgage, you can take either a variable or adjustable rate mortgage or a fixed rate mortgage. Like normally the adjustable rate mortgage usually has a lower rate than the fixed rate.
Yeah.
Okay. Because there is a risk the interest rate will go up and then, you're on the hook higher interest rate payment. But let's say the interest rates were low and, you were kind of reckless and you say, okay, I'll take a loan at, 1% adjustable. And then the rates go up and then you want to maybe switch to a fixed rate because, you expect the rates will keep on going up. So what do? You go to the bank, okay, and you have to refinance, meaning you need to get entirely new loan.
Yeah.
Okay, for another 20 years. So this is what it takes to switch between adjustable and fixed. And normally you're going to get a rate hike. So maybe you got 1% and now the situation changed and you get maybe 6% fixed. I'm making those numbers up, but let's say 6%. Okay, imagine at the same time I took a loan at the same amount, but I took a fixed rate mortgage. Okay, I got it at 3%. And now I'm still at 3%, okay? And you went from 1 to 6, theoretically, right? You went to maybe 1 to 5, but adjustable. So I have 3 and you have 5, and you want to switch to fixed. So what you can do is you go to the bank or refinance, or you can come to me and say, hey, Lucas, how about we do it this deal? For 1 year, because I'm guessing 1 year is enough and everything is going to change. For 1 year, we signed a contract that you will pay my floating rate, okay? And I'll pay you 5%. So you're paying me less than you would pay in the bank. So it's a win. I pay you 3%, which is 2%, delta. I'm taking a risk if the interest rate is going to go up. So yours is 5, maybe we agree on 5.5. Okay. So I get 1.5% delta and my cost of capital is also lower because I have my base at 3%. So you win, I win. Okay. I'm making money. You're making money. Bank doesn't make money. But for 1 year, I pay your interest. You pay my interest. You save, I get to earn some extra. And this is what actually banks do. If they want to switch, or in big corporations, when they want to switch from fixed to floating or from floating to fixed, they don't refinance. Okay. Yeah. They keep their own loan or they keep their own deposit. Okay. The money doesn't move. All they do is they get a swap. And swap is essentially a contract for parties to pay each other's different rates. I pay you adjustable, you pay me fixed.